Emma and I are joining you from dreary London, where it's dark, cold and wet, and sadly we're all still in lockdown, so we're desperately sad not to be out there with you all in person. And while technology provides these great tools, we can see this morning there's always some hiccups. I don't think it's ever going to be a substitute for actually getting out there and meeting people in person. So hopefully this is a one-time thing, special circumstances, and Emma and I are out there seeing you all in person again next year. We were going to follow our normal format today. So Emma's going to spend a bit of time talking about the Global Value Fund and our performance this year. And I was going to spend some time talking about markets and the big picture. And then at the end, something that I hope we all find a bit interesting, I wanted to spend some time talking about corporate governance, holding companies to account, something that's very important to our investment process. And lastly, we're here anyway to help, any way we can to help. So if there's questions, we're delighted to answer those. I think given the virtual format we have this year, we'll probably have to save questions for the end. And I've seen, I think 1 or 2 people have asked if they can use the chat function to ask questions. I don't see any problem with that at all. But it might be easier this year if we just save all the questions at the end. It might be a bit hard with all who's in charge of the mic, but yeah, so perhaps we might go about it that way. And with no further ado, I might hand over to Emma to talk about Global Value Fund.
Thank you, Miles, and thank you, everybody. It's so great to see all your faces. I'm just going to share my screen with you, and hopefully the presentation will come up on the slide. Let's put it into a slideshow for us. Okay, hopefully you can all see that on your screen now. And you know, just to reiterate what Miles was saying, thank you so much for spending the time. Many of you will know about GVF, but for those of you who are new to GVF or joining us for the first time, I thought I'd spend just a little bit of time talking about who we are and what we're doing for you, our investors. We have a very differentiated strategy at GVF. We're not stock pickers. Instead, our core skill set is an ability to unlock value from our investments. Essentially, what we look to do is we go around the world looking for places where we can buy $1 worth of assets for a lot less than $1. And then the way we outperform is by unlocking this value, often through hands-on techniques, like, for example, shareholder activism. Our stated aim at the Global Value Fund is to target global equity market-like returns, but to do so with a much lower risk profile than a traditional basket of international shares. We're aiming to be the steady Eddie in the portfolio. What we're looking to provide investors with is 2 sources of return. First, the returns that come from the underlying assets that we've purchased. And then secondly, topping up those returns with unlocking the discounts that we've found around the world. The way we achieve the lower risk profile, and I'm just going to slide forward here on the pie chart, the way we achieve our lower risk is through diversification. So on the slide here in front of you, hopefully you can see 2 pie charts that we update on a monthly basis. And on the left-hand side are all of the asset classes so that we invest into at any one point in time. And as you can see, it's only of a part listed global equities, part listed debt, part listed private equity, listed hedge funds, and then some alternatives and cash. And that's the way we keep the risk profile down, through diversification. On the right-hand side is the basket of currencies. And our approach to currencies is, again, one of driving down risk and diversification. And our basket of currencies aims to reflect the global investable universe, with the exception being the Australian dollar. We hold more Australian dollar simply because it's the lowest risk currency for an Australian dollar company to hold. The way we then target those higher returns, as I said, in spite of this low risk portfolio, is to strap on top all of the investment, all of the returns that we get by unlocking the discounts that we find all around the world. To show this another way, I'll just put forward this, this graph here. This here is a attribution exercise. So the first blue wave is the returns that we've achieved since IPO from that basket of assets. So this pie chart over here is represented by the blue wave and the returns that we've achieved there. And as you can see, low risk means low returns over that period. The gray wave represents the returns that we've achieved from the currency basket. So this basket here of currencies has produced these sorts of returns here. And again, you know, low risk, low returns. The navy line on top shows GVF's net after all fees and costs investment returns. This line hopefully illustrates the market outperformance that we've delivered through time. In terms of financial markets, you know, this year with the arrival of the coronavirus, it's been one of those black swan events that hits markets from time to time and brings about a severe correction. While we hope to never see periods like this, Miles and the team spend most of their time, or a lot of their time, planning for these sorts of events. We know that during moments of extreme market financial stress, the price of things that we own are going to behave irrationally for a period, and they may even record short-term losses. We are not afraid of this. We know that during times like this, the underlying value in our portfolio hasn't gone anywhere. Instead, what we focus on and design the portfolio to be prepared for is the ability to get on the front foot during periods like this. The catalysts that we've built into our portfolio, i.e. the ability to unlock the value regardless of what market conditions do, provides us with the capital to quickly recycle the portfolio to take advantage of the much more exciting opportunity set that we found ourselves in after the crash. Instead of trying to predict when periods like March are going to arrive, we focus on being able to recoup the losses and to come out the other side with a portfolio we're even more excited about than the one we went into the correction with. And while the portfolio, as you can see, did see a drawdown over March, by October, we'd made back all of these losses. On a net basis, GVF's investment returns are back to their all-time highs, while for comparison, global equity markets in Australian dollar terms are still 9% below their peak, and the Australian share market is still 15% below its peak. More importantly, having turned the portfolio over heavily, the amount of underlying value sitting within GVF today is much higher than we would normally find, which we believe sets us up well for the year ahead. During the depths of March, we were saying two things to investors. The first thing that we were saying was that the losses we had incurred were largely mark-to-market events that did not reflect the underlying value within the portfolio, or our ability to release this value. And the second thing we were saying was that the sell-off was providing us with an incredibly exciting investment environment for our unique opportunity, and we were capitalizing on this. Hopefully this next slide illustrates that we meant what we said. This bar chart, or these bar charts, the bar charts in blue show investment returns for the calendar year 2020. So from the 1st of January this year. And as you can see, global equity markets and Australian markets, they are down 1% and 9% respectively. Global credit markets are up 0.5%, and the global value fund is up 3.2%. The gray bars then show investment returns for the financial year 2021, so the 1st of July onwards. And here again, GVF is up 9.1%, well ahead of the other asset classes. It's worth saying that we don't think that we're done with this extra exciting period in the portfolio. It's still full of lots of value, much more value than we would typically find. So we remain really optimistic, more optimistic than usual. I mean, it's fair to say we're always optimistic about our strategy, but more optimistic than usual for the coming year. Since launch, GVF's annualized net returns after all fees have been 8.8% per annum, a result that's been achieved with a much lower risk profile, as I was saying earlier. Probably the most important tool that we use to ensure that shareholders directly benefit from the returns that the portfolio generates is the fact that we aim to pay out all of our investment returns back to shareholders over time as franked dividends. This slide in front of you hopefully illustrates that commitment and hopefully shows that consistency and reliability of the income stream. Since IPO, investors have received back almost 50 cents on the $1 investment that they made in 2014. On top of this, and after the dividend payment that just hit our account on Monday, our profits reserve currently sits at 11.3 cents, which is almost 2 years of reserve dividend tucked away for the future. Just sticking with this topic, a subject that came up a couple of times at the virtual roadshow that we've just concluded was a question around whether GVF was looking to be an income play or a capital growth play. And I think what I'd say there is, one of the huge challenges that all investors are facing today is how on earth we're going to generate any sort of income from our savings when interest rates around the world have fallen to zero. What we aim to do at the Global Value Fund is provide our shareholders with as much flexibility and choice as possible when it comes to the level of income that the company, that you receive from the company. To achieve this, we've made the commitment to pay out all of the returns that we generate over time, and that underpins that 8% running yield that we run with. In committing to pay out all of the returns through time, we are deliberately handing over to you the choice of whether you'd like to reinvest that money yourselves, some or all of it, or whether you'd like to take all of that money as income. The default setting for any shareholder joining us is to receive everything in cash. For shareholders that prefer to see their investment, their investment compound through time, we suggest that they enroll in the Dividend Reinvestment Plan, or DRP. GVF operates that DRP for you, and it is set up such that you will always receive the lowest investment price possible. If anyone is interested in enrolling, please just email me directly. I will then coordinate that directly with the registrar. It's about a 2-minute process, and we'd be happy to have you in the DRP. One tiny little piece of housekeeping before I hand over to Miles for the main event, and that is some good news from our side. I wanted to share with all of you that we made a very important hire this year. His name is Mark Ambrose, and he joined us in March, which, as you can imagine, has been an absolute baptism by fire. Poor guy has not even worked a day in the office with us yet, but he's plugged in really, really well. We're really enjoying working with him. Miles and James have known Mark for over a decade. We were talking to Mark for at least 1.5 years before he joined the team. He's a very senior hire for us, and he adds greatly to our capacity on the portfolio management side. He has a master's in mathematics, can code in a number of computer programming languages, and he joined us from a large US investment bank where he specialized in the exact type of investment situations that we target. So, we're very excited, and it's worth saying, despite having only been with us for 8 months, he and I, under the stewardship of Miles, conducted or spearheaded a activist campaign earlier this year in London. In fact, we talked about it. We're about to talk about it in our monthly coming out, and it's worked out really well so far for GVF. So he's really someone we're excited about, and hopefully we can get him on the video so you can get to see him and the rest of the team. But I might hand over to Miles now for the macro and the G in ESG.
Thanks, Emma. Thanks, everyone. I think you did yourself in a little bit. I think we put my name on a few of those activist letters, but I'm pretty sure it was just you and Mark that did all that work. But I'll take the credit. And look, so thank you, everyone, and please bear with us as we go with this format. I've seen a few people asking questions in the chat function, and I'm very happy to answer them that way. That's easier for people to ask questions. I think, though, this year we'll just save all those for the end. And I think, Emma, are you going to manage the slides for me? Am I going to? manage the slides. Yep. Okay. Maybe flick to the first one. So I'll spend a few minutes just talking about markets. You know, the team and I sit here in London and absorb a lot of information and really are at the coalface every day. So we're always happy to share what we see going on. I think you've jumped ahead a few slides there, Emma. Here we go.
Sorry.
Well, okay. So markets. You know, Jonathan Ruffo is one of the doyens of the City of London. He has got this great quote which basically runs along the lines of the art of investing is the art of juggling grenades. It's a statement that's always run very true for me. And looking out at the big picture today, there's certainly some potentially very nasty surprises floating around us. Recently, though, probably the nastiest surprise has fallen on those who, rightly or wrongly, have been too cautious. You know, since the March crash, virtually every asset class around the world has seen a tremendous rally. And no matter how worried you were about COVID or the economy, with hindsight, the biggest investment mistake you could have made over the last 6 months was to be underinvested. The driver for this, somewhat perversely, has been how much damage COVID-19 has done to the real economy. The lessons that policymakers learned from 2008 and the financial crisis was that during these extreme crisis events, far less overall damage is done at the end of the day if you act very quickly and very aggressively. And since the GFC, too, policymakers have learned that a lot of the sort of the unconventional tools they dreamed up then, like quantitative easing, a lot of the fears we had about those sorts of policies were overstated. So people are much more comfortable using these tools today. So fast forward to this year, you know, as the damage from COVID became clear, governments everywhere stepped up in a way they've just never really done before. In just 2 months of this year, the US Federal Reserve bought more treasuries than it did during 5 years of its quantitative easing programs after the financial crisis. You can see that on the bottom chart here on the slide. The year-on-year increase in the monetary supply in the US, it's really without precedent. It absolutely dwarfs any of the actions that were taken during quantitative easing and the GFC. In tandem with central banks that have been handing out money like it's going out of style, governments too have joined the party. Something like $4 trillion in spending cuts and tax cuts, spending and tax cuts have been announced so far this year, and of course they haven't finished yet. So those dynamics have, you know, from that, markets have learned two important things, or have taken two important things away. The first is there seems to have been some wholesale change in attitude to government spending. After the GFC, I'm sure we all remember, the mantra in developed countries was austerity. You know, the need to live within our means, the need to get our budgets under control quickly. Today, policymakers and the general public as well have a very different mindset about spending and using debt. And markets for now have learned that politicians are committed to protecting the economy at all costs. Whatever weakness comes up in the short term, the market is betting heavily that there's going to be a big fiscal response. The second lesson is that, you know, if you thought interest rates were low before COVID, you really haven't seen anything yet. Central banks have telegraphed heavily that interest rates are going to be close to zero for years and years to come. What does this all mean? Well, for the first point is that markets expect any economic downside is going to be well protected. As I was saying, the betting in the market now is governments are going to act aggressively and quickly if we see any downside. So markets feel like they've got a safety cushion below them at the moment. The second point is that, you know, lower interest rates means higher asset prices. As we've written about before in some of our literature, if you take the mindset to the extreme, and if you assume interest rates are zero in any financial model that you're putting together, the calculated value you get for that asset is infinity. It's endless. It's as big as any number can go. So while it seems perverse to some people, and it's certainly hard to swallow that, you know, cutting interest rates protects the economy, the flip side to that is that it means that interest rate sensitive assets, particularly share markets, can continue to move higher, despite how bleak it all looks to us as we're looking around and seeing people getting made unemployment and how bad the real economy is. So those two factors have been what's underpinning markets since March. And on top of that, you know, markets are forward-looking instruments. They price the future, not the past. And what they're doing now is looking forward to 2021 and looking for two big events. The first is a rollout for the COVID-19 vaccine, and the second is a significant bounce back in global GDP growth. You can see that in the top chart on this slide here, and that's expectations for global GDP growth going into next year, 2021. You can see markets are expecting growth is going to run at nearly 5% globally. And if that was the case, that'd be the strongest reading in global growth for nearly 30 years. So combined with the vaccine, combined with all the government support, markets have had a wonderful time, even if the real economy has been quite a bleak place. If we just flick to the next slide. So those are the reasons markets are rallying so strongly, despite how bleak the economy actually looks to all of us. Coming back to Jonathan Ruffer's grenades, however, that outlook is obviously not without risk. Probably the biggest risk centers around a COVID vaccine. Expectations are very high now that we have one, and look, it certainly looks like we do. But however, any unwinding of that view that perhaps it's going to take longer or worse, perhaps for health reasons or safety reasons, it's not feasible, that's going to have a pretty severe impact on risk assets, one that government spending on its own probably wouldn't be able to plug this time. So while it's not comfortable to think about these sorts of outcomes, we also can't wish them away when we're thinking about the investment risks we're taking on. Apart from the vaccine, probably the other main area, at least in my mind, where markets seem to have a bit of a blind spot is who's going to pay the bill for all the spending that governments are doing today. And if you think about the equation coldly, you don't think about what's sort of morally right or wrong, but just what's possible. There are really only three ways to get debt or debt to GDP under control. The first is default, which is not really an option. The second is some combination of raising taxes or cutting spending, though again, after the GFC and after years and years of austerity, particularly here in Europe, there really isn't much appetite for spending cuts. So I think it really has to fall on raising taxes. And then the third is negative real interest rates. Now, negative real interest rates mean that the rate of inflation in an economy is higher than interest rates are. In simple terms, it means if you put your money in the bank, it decreases in value over time. Inflation eats them away faster than the interest you earn. Negative real rates are horrible things for savers. They're a tax on savers, and they're an absolute lifeline for lenders. For borrowers, what it means in effect is that the value of your debt decreases over time without you actually having to pay any of it back. So it's wonderful if you're a lender. Because it's a silent tax, it really makes the headlines. It's much easier for politicians to let debt get inflated away, tax savers silently, than it is to go out and actually raise actual taxes. Ultimately, somebody has to pay the bill for all the money we're spending today. And we needed to spend the money we needed to protect the economy. That's not really part of the debate, but there is going to be a debate coming about how we pay for all of this. It would seem likely that it's going to be some combination between actual tax increases and a tax on savers, inflating the debt away. But our assumption is, and that's certainly our assessment, is that because the second of those is so much easier than the first, it's probably going to rely more heavily on inflating that debt away. Our assessment would be negative real interest rates are going to be with us for some time, and then in the medium term, inflation starts to make a bit of a comeback. So it's something that we haven't had to worry about for quite a time now. The chart on this page that Emma's got up for us, this shows the negative, the real yield, so the inflation-adjusted yield on the US 30-year bond. And I've chosen this bond because this is basically the longest period of money you can lend. This is the longest period of time you can lend money to the US government at the moment, 30 years. You can see this real yield went negative in March, and it's stayed negative since. And what in effect that means is if you buy this bond from the US government, you're lending Uncle Sam money for 30 years. You don't get to use your money for 30 years. And at the end of that, you're going to get less money back than you paid, or the value of your savings are going to decrease over time. It's a pretty rubbish equation. And unfortunately, probably one we're going to have to swallow for some time, in the sense that without raising aggressively actual taxes, taxing savers is probably going to be the default for a lot of politicians around the world. Anyway, moving away from the big picture, if we could just flick into what I wanted to spend most of my time talking about today. Yeah, so we always present, we always think about some topics to talk to our shareholders about, and generally they're about markets. What I wanted to spend some time talking about today was a bit different, and that's corporate governance, which on its own probably sounds really dry. It's actually not. Corporate governance, holding managers and boards to account, goes right to the heart of the cut and thrust of the shareholder activism we often engage in around the world. Many of the assets we find when we're out there employing our strategy are so cheap because there has been some failing in corporate governance. Boards and managers are there thinking about themselves and not the people that they're there to serve. I'll start by talking about how the system is supposed to work, and then touch on how it often breaks down. Firstly, just starting with the big picture, capital markets, there have been these wonderful creations. Within the rules that society sets, they unemotionally allocate capital all around the economy. They move it to where it's going to be most productively used. And in doing so, they raise living standards for everyone, they create wealth. And when they're used well, this is probably one of the most important features, I think, when they're used well, they level the playing field. They get rid of cronyism, they stop cartels, they get rid of self-interest. They're a way of shining sunlight and making sure everyone has a fair playing field. One of the challenges, however, they bring, particularly when you're thinking about the share market, is that they separate the ownership of companies from the management of companies. And if you think about it, there's very few family businesses out there that can attack the capital or the talent that's needed to go and build something like a BHP. So by separating ownership from management, capital markets raise a lot more money than private investors can. You can attract very high caliber individuals to run those companies. And it means that within the framework you've created, you can build these companies that go on to do much greater things than private firms can. The flip side is that share market investors today get disintermediated from being the owners of the company, and they basically buy and sell parcels of company ownership and hire professional managers to run their business for them. In doing this, we create what's called an agency problem. Shareholders become very small individually and very disparate, and they actually have very little access to the managers that are there running their businesses. This is still owned by shareholders. Managers on the whole are good people, but as Paul Keating used to like to say, in the race of life, always back self-interest. Left unsupervised, managers have a horrible tendency to start running companies in a way that suits them, not shareholders. Our solution to that within capital markets, or our solution to this agency problem, is to appoint independent boards. And their job is to go in and hold managers to account, to act as the guardians of shareholder capital. And they are appointed by shareholders, and shareholders pay their salaries. For large, well-intentioned companies, that set of relationships generally holds up pretty well. For the BHPs of the world, they attract very high caliber directors, generally industry experts who understand their obligations to shareholders very well. But even in these large companies, that the relationships don't always work as planned. The recent recent World Commission into the financial services sector showed how far the boards of big famous companies like BHP, how far those of AMP, how far those companies got removed from, let's call it, the naked self-interest of the management teams that were reporting into them. More worryingly, as we get down the market capitalization threshold and start to look at smaller and smaller companies, the caliber of directors serving on these boards can at times, start to fall away. That's certainly not a general statement, but as an observation and as someone that's done this for a long time, and as a firm, we've engaged in corporate activism and shareholder advocacy all around the world for, in many different countries for a long period of time now. One of the things that we often pick up is that when you get to smaller companies, too often boards get co-opted by their management teams. And the risks here, almost all shareholder feedback comes to the board through the manager these days. So boards are at risk of managers massaging the feedback in the best case, or curating it in the worst case. And further adding to that co-opting process, shareholders come and go today with this incredible speed. If you look at the US share market, the average holding period for a share today is just 6 months. That's down from 2 years in the 1990s and then 6 years in the 1960s. So in contrast to the shareholders, the owners of these businesses that come and go every couple of months, the boards and the managers actually work together for years, sometimes decades. And you can see how, the different relationships build up, and perhaps not the chain of relationships are in place the way they're designed to be. Within all of that, you can start to see how some of these corporate governance relationships, how they're supposed to work and how they potentially break down. We've done this little flow diagram here to try and to talk about this, and you have to excuse me, it's very early here and I need a little drink of water. So on the left, we're showing how the relationship is supposed to work. Shareholders appoint directors, they pay their wages. The boards then in turn are accountable directly and only to the shareholders they oversee, to their shareholders. Boards then oversee management. They offer advice when it's needed. They hold managers to account when it's necessary. And managers lastly get on and run the company with a nice clear mandate, prioritize shareholders and shareholder returns. Sadly, when corporate governance starts to break down, however, the framework begins to look a little bit more like what's on the right-hand side here. Managers start to set their own priorities. Sometimes these overlap with what's best for shareholders, sometimes they don't. Boards have very little engagement, if any, with the shareholders, and run the risk of being heavily co-opted by management, and importantly, management's vision for the future. And what happens then is, shareholders who are supposed to be the owners of these businesses, they're left with two options: accept the outcomes that management are delivering, or sell your shares and move on. That second option is called the Wall Street walk. The notion in financial markets is that shareholders, if they're unhappy, they just sell and go and invest their money somewhere else. Personally, I've always found the notion of that Wall Street walk outrageous. You know, when it gets to that point, the entire premise of how capital markets are supposed to work has broken down. The point of public companies is that public scrutiny and shareholder democracy is there to shine a light, to hold people account. And if shareholders don't exercise those rights, self-interest, cronyism can set in quite quickly. Worse, this cycle becomes self-fulfilling. You know, when shareholders start voting with their feet, not their hands, vested interests learn a very dangerous lesson. And once they've learned that, the problems tend to get worse over time, not better. They realize that they can, you know, they can set their own agenda, and they're not really held accountable for that. And lastly, one aspect I thought would be interesting to discuss today, and something that we've certainly noticed in the last few years, and that's, you know, the impact that the big growth in passive investing has had on this equation, the big rise of the ETF industry, so passive investing. And I'll just say a little preamble first. You know, I personally think the premise of passive investing is really smart. You know, don't bother trying to analyze the market in great detail. Efficient market theory tells us that everything's already in the price. So instead, just go and passively invest your money into the market and let others go and do the hard work for you. And that logic is certainly boosted by the fact that after fees, the average fund manager these days typically underperforms the market. So there's a lot of good reasons why passive investing work, and it's been a wonderful boon for investors. It's certainly held active managers like me to account, and has been wonderful in terms of fees and all of these other great things for investors. But in terms of corporate governance, it's created quite a problem. You know, as passive ownership of the markets increased really exponentially in the last few years, it's meant that there's fewer and fewer shareholders actually involved in the process of holding managers and boards to account. And to be clear, I mean, ETFs are wonderful things, but they don't get involved in proxy fights. They don't hold managers and boards to account. They often don't vote the shares that they own in their fund. And if they do, they almost always, I've never really seen an exception to this, they almost always vote in favor of management, and they don't really have a mandate that lets them do anything other than that. So while on one hand, you know, the rise of ETF investing has been this great win for investors, on the other hand, it's really starting to badly amplify this agency problem that already existed in the share market. What this all means, and I guess this was the little parting comment I wanted to leave with all of you, that it's really more important than ever these days that shareholders pay attention to what's going on at their company, that you engage with your boards, you vote at company meetings, and if you're unhappy, please vote, but with your hands, not with your feet. You own the companies that you invest into, and the people running them are supposed to be there working for you, and you should have that mindset, and you should approach the equation in that way. At GVF, we very much live in this world of the agency problem. We spend much of our time standing up the management teams and boards in underperforming companies. And I'll be honest, the team and I get a lot of fulfillment out of these situations. You know, we go into them, work very hard to find a solution that obviously makes money for GVF investors, but also stands up for smaller shareholders, gives them a voice, and stops, in many cases, you know, small retail shareholders being taken advantage of in some of these situations. Anyway, that was what I wanted to say about corporate governance. We were going to finish off today with just one quick little case study to give some insight into the sorts of things going on in the GVF portfolio at the moment. Thanks, Emma. So look, philosophically, one of the things that I think sets GVF apart is that we spend, I think, as much of our time thinking about risk and protecting capital as we do on generating returns. We're always looking for opportunities where that risk versus reward equation is skewed in our favor, where we can see a great return opportunity, but where the downside is also really well protected. This investment, Hybrid's Tactical Credit Fund, perfect example of this. It's our second largest holding in GVF now. It's nearly 8% of the portfolio. And what it is, it's a small listed fund that invests into a much larger hedge fund run by New York-based Hybrid Capital Management. The underlying product here is a market-neutral hedge fund that invests across a range of different credit strategies. And what a market-neutral hedge fund is, or a market-neutral fund, they're designed to protect investors through market crashes. And this year, Hybrid have done a terrific job of that. You know, through February and March, when everything was crashing in a pretty scary way, equity markets were down nearly 25%. Hybrid, their fund was down just 3%. And year to date, now coming out the other side, they're up 13%. So they've outperformed pretty much every other asset class you could think of. What attracted us to this situation was that we were aware that it was small and subscale, and importantly, the board a number of years ago had made a commitment to allow shareholders to wind this trust up if it didn't get to a certain size by the end of this year, 2020. Now, boards and managers have a horrible tendency of wiggling out of these sorts of commitments, especially as time goes by. But if there was a vote to be held and if the fund was to be wound up, it would offer an opportunity for investors to exit at asset backing. Where this investment became really interesting for us and the team and I was during the sell-off in March and April. Despite how well the underlying fund itself was doing, its share price sold off really heavily during the market crash, and we were able to build a very big stake in this company at incredibly cheap levels. We're now the second largest shareholder in the company. Since then, we've spent a lot of time behind the scenes engaging with the board, other shareholders, basically to ensure that this promised continuation vote does happen on time and as planned. And recently, encouragingly, the chairman, who's been a wonderful person to talk to and very judicious and sensible, the chairman announced that the company would be holding the continuation vote that we've been holding to account on, and importantly, that they put in a preemptive redemption request into the master fund, which is again something we've been lobbying for them to do. What that means in practice is it basically brings forward the exit opportunity for shareholders if they wish to leave, which really enhances the overall returns in the investment. So what we find really attractive about the situation now is that this exit opportunity that's coming up, and importantly, the discount that we own the shares at, mean we expect to earn like an annualized return in the order of 16% a year just by releasing the underlying value in the investment on its own. And on top of that, of course, we're going to pick up the returns that the hybrids themselves generate. So potentially we're looking at something in the region of a 20% annualized return target for this investment. That's a pretty high return target. Despite that high return target, the thing that I really love about this trade is the underlying, despite having this wonderful high return target, the underlying risks in the investment itself are quite mild. Even during the worst of the crash this year, hybrids was only down 3%. And if we were to have another big pullback in the market, we would certainly expect to enjoy that kind of protection again. As I was saying, this is one of GVF's largest holdings at the moment, and hopefully a good example of the sorts of things that we spend our time hunting out for investors around the world. Now that was all I had prepared today, and I hope we've managed to do our best in this virtual format.